Chapter 2 of Financial Studies, Consumer Credit. In this chapter, you're going to learn the meaning of consumer credit. And you should know how to classify different kinds of consumer credit, and you should give examples, and you should value your personal credit records. Now, you should know what is consumer credit. First one, you should know the definition of consumer credit, and you should know the benefits and its problems. So, first we go to the definition. Consumer credit consists of the loans obtained by the consumers for the consumption of goods and services. It means that this kind of credit is a kind of loans, but actually maybe the financial institution will grant you the loans, may lend you the loans, and you borrow loans from these institutions to buy your goods and services. Just like credit cards and personal loans. Now, you're going to learn the benefits of using consumer credit. Say you use a credit card as an example for you to have a good memory. First one, can have a chance of acquiring expensive items without enough cash. That means you want to buy, say, for example, you buy a motor car, but it costs you $400,000. You do not have enough cash. You may go to ask for a personal loan to buy that car. So if there are no institutions who are willing to lend you the money, you cannot buy it. As well, second point is you do not need to carry large amounts of cash. Say for example, even though you have $400,000, but you will not go to the bank and take the bank notes out of the bank and carry a large bag of cash to buy your motor car, right? Usually you will not do this. So with a credit card or with a personal loan, you may not need to carry a large amount of cash. Of course, once you use credit cards, the credit card companies will give you points, bonus points, for you to buy, redeem, say for example, park and shop coupons, flight miles, and so and so. But there are still problems. More expensive in terms of the interest payments compared to credit with collateral. That means when you use a credit card, you need not give a collateral. A collateral, it has another meaning of mortgage or security. It means you have something put in the credit card companies in order to buy expensive items. Say for example, if you want to buy a flat, you have to give your flat to the bank in order to obtain the mortgage loans. So in this case, when you buy a flat, you have a mortgage in the bank, so the bank is willing to lend you the money. But if you want to buy motor cars or TV set, the credit card company does not need you to give the TV set or the motor car for the company as a collateral. That means the risk of bad debt for the companies will be higher than with the credit with collateral. So you have to pay much higher interest payments than the credit with collateral. Of course, if you apply for many credit cards, there may be a chance of overborrowing. Quick quiz: consumer credit is often secure or unsecure. Secure means with a collateral. Unsecure means without collateral. Yes, the answer is unsecured. Yes. What does unsecure means? Unsecure means the lending institutions does not require any collateral on the loans. Okay, let's go to the classification of consumer credit. So you see the picture that consumer can be a revolving consumer credit or a non-revolving consumer credit. What does it mean? Revolving, just like you see the merry-go-round, you just say the credit card company will give you a limit. Limit, that means the maximum amount of the loans or credit that you can use with the credit card. You buy things with the credit card. So, say for example, if the credit card company grants you $100,000, that means you can buy TV sets, buy mobile phones, and so and so, unless the credit limit is not exceeded. It's not exceeded. So it's just like the merry-go-round that if you pay the credit card company, say for example, $60,000, that means you still have $40,000 that remain for your use. That means the $100,000 limit will just like merry-go-round will go up and down when you pay the credit card company. What non-revolving credit limit credit means it's just like a straight line. That means if you want to buy a motor car, say for example $400,000, the company, okay, the institution, financial institutions will calculate the total interest for, say for example, 5 years of time, right? 5 years of interest with $400,000 together, and will divide the principal and interest, that is the amount, by 5 years of time. That means 60 months. So each month you have to make installments to the company. Okay, so it's just like a straight line that every period, that means every month, you have to pay to make installments to the company. The installment is fixed without change. There is no flexibility for you to not to pay this time, but pay in the other months. No way. So this is what we call non-revolving. Another classification is installment and non-installment credit. Let's go on to see. Revolving consumer credit, you see just a ceiling in the picture, as shown in the picture. That means there is an upper limit for the credit is given to you. Let's look at the words. Okay. Revolving consumer credit is a kind of credit that allows the consumer to draw credit as long as the total amount of credit is within a limit. All right. Say for example, if the credit available for you is $40,000, the credit limit is $100,000, and the outstanding amount is $60,000. That means the credit available is $40,000. Outstanding amount means the amount you use to pay for your goods and or services. Examples are credit cards and overdrafts, just like bank overdrafts. What non-revolving? Non-revolving just means a straight line, to make installments regularly. Okay, non-revolving consumer credit is a kind of credit that allows the consumer to draw credit limit to a particular amount. That means the financial institution will lend you a particular amount of the loans, and the institution will calculate the total interest for the whole period for you. Examples, car loans, just like this. Maserati. Okay, we're going to compare between revolving credit and non-revolving credit. First, usually, revolving, just like a merry-go-round, you see just like the fishing line, it flows up and down depending on the water level, up and down, okay? So the number of repayments is not fixed. That means it's very, very flexible. You see the third row, that revolving credit has a high flexibility. That means if you are available, you may pay back some amount. If you are not available, you may will not pay it. Okay, so there is no fixed amount of repayment. Of course, with higher flexibility, the company will face a high risk of being getting bad debts from you. So the financial institutions will charge you higher interest rate. Will charge you higher interest rates for a higher flexibility. On the contrary, non-revolving credit, like a straight line, is fixed. Every month you have to pay a fixed amount of installments or repayment. But you know that the flexibility is a little bit lower because every month you have no choice but to pay that fixed amount. Without flexibility, of course, the financial institution is facing a lower risk of bad debts, so he is willing to give you a lower interest rate to obtain this credit. Quick quiz. A bank offers a revolving consumer credit account to Tony. The credit limit is $15,000. Tony purchases a mobile phone of $5,000 on credit using a credit card maybe. Now the credit available is very simple, right? Just minus is $10,000. What does revolving means? Revolving means as long as the consumer is making satisfactory repayment to the institution, the credit available will be adjusted back to the credit limit. Just you move up, right? If you have paid back, say, look at question 3. If you have paid back $5,000 to the credit card company, the credit available will rise back to $15,000, just like question 3. Okay, let's compare installment credit and non-installment credit. Look at the definition. Installment credit allows the consumer to obtain credit for consumption with periodic repayment of the loan. Periodic, just like monthly, or half monthly, or semi-annually. Non-installment credit requires the consumer to repay the full amount of the loan in a lump sum. Say, for example, if the financial institution lends you the money for 1 year of time, that means you need not pay anything together with the interest until the end of the year. Until the end of the year, you have to pay a lump sum of the amount, that means including principal and interest to the financial institutions. Okay, let's go on to compare these two types of credit. First one, installment credit. You know the repayment period is periodic or regular, while non-installment credit is no repayment period unless the end of the credit, the end of the time. Okay, the end of the time to pay the full amount of the loan in a lump sum. Of course, the repayment amount is lower, while non-installment credit, the repayment amount is higher because the company has to face a lot of risk. Not only 1 year, say for example, the financial institution is giving you 3 years of time to pay the whole amount, okay, together with the interest at the end of the 3rd year. That means first year, 2nd year, and the 3rd year, the company will not see you and will get nothing, right? Unless the end of the day. So the company will face a lot of risk. So the repayment amount must be higher. Higher risk, higher return. Okay, higher risk, highest return. So the repayment period should be shorter. That means in financial institutions will not let you to have a long period of time to repay the lump sum. Because the risk is very high. Okay. Let's look at the examples. First one, installment loan. Second, bank overdrafts, or we call OD. Third one, credit cards. Okay, first one, installment loans. Examples, mortgage loans. That means the loans you buy an apartment, car loans, pay tax loans. You click the Hong Kong Shanghai Banking Corporation. You'll see a lot of choices. One is the home mortgage loans. Okay, financing life. What is mortgage loan? A mortgage loan is a type of installment credit. That means most citizens cannot pay the full amount of expenses when they purchase a flat. Which may amount to $5 or $6 million, right? $5 or $6 million. How can us ordinary citizens can buy this flat with a lump sum payment? They apply for mortgage loan from the banks. Usually, the bank will offer not the whole amount of the price of the flat. Say for example, 5 million. Okay, 5 million. Usually, banks will offer 60%. 60% of the loans. That means 60% times 5 million. That means we'll offer you $3 million only. You are required to save for $2 million together with some extra expenses. For buying the flat, $3 million. Okay, you have to put your flat in a bank as a mortgage, until the end of the installment period, that you can get back the mortgage. Mortgage loans. When a customer pays part of the expenses, he can obtain a flat. Then we pay the rest of the expenses according to a fixed schedule. Let us look at installment loans. Now, the advantages are fixed repayment period. Remember, fixed is an advantage. Fixed is an advantage. And periodic repayment amount can be lowered. It is easy and fast to obtain. But the disadvantages are they are fixed rate loan. The rate cannot change. Even though the interest rate will fall in the years to come, if you you agree with the bank to make a fixed rate loan, the rate will remain unchanged for the whole period of time of your terms, fixed terms. Bank overdrafts. Bank overdraft occurs when the financial institutions grants the client the right to draw money from the bank, even though the account does not have enough money. That means if you have only $100,000 in the bank and you want to draw the check and pay the check to your to buy the car, you have to draw a check for say for example $300,000. That means it is more than what you have in the bank. If the bank allows you to give you these facilities, that means it is an overdraft, and you may draw a check over $100,000 to buy your car. Okay, of course, the bank will charge you overdraft interest. The rate of the overdraft interest may be very high. Okay, go on. Credit cards. Credit cards allow the consumer to make purchases on credit. Since the credit card is a revolving credit, any credit used will be charged interest if the payment is not paid in full at the payment due date. That means if you use the credit card to buy your goods, the credit card company will give you a month or a month and a half month as an interest-free credit period. I called you interest-free credit period. That means during this period, you do not need to pay interest to the credit card company. But after the deadline, after the due date, okay, you if you still cannot settle the amount, the outstanding amount, you have to pay a very, very high interest for the credit card company. Even though the minimum payment is not enough for you to cover the interest after the due date. Types. We have standard credit cards, premium credit cards. Okay, that means the differences between these two cards are the upper limit that a credit card company will give you, and the bonus points. That means you get more bonus points for every consumption or many privilege for some shops or hotels. Affinity. Affinity means together with. You see, Hong Kong Baptist University have an Infinity credit cards with Hang Seng Bank. That means when you use Hang Seng Bank in this university, you may gain some advantages, some more bonus points or a discount when using the facilities or enjoying meals in the restaurant in Baptist University. The advantages of using credit cards are it's so convenient for you, for consumers to use credit cards to buy things, and it is safe enough. As you look at the picture, if you want to buy expensive things, you have to carry a lot of cash if you don't use credit cards, right? So this is very convenient, and it will avoid the risk of being lost. the risk of being lost. Second, you have the payment flexibility. Payment flexibility. That means you don't have enough cash. It is flexible enough for you to defer payment. But of course you have to pay interest, right? Second, the credit cards are widely used in the world, in many countries. It's called worldwide acceptance. And currencies translation. It means you may use a credit card to change the currency of that country. Say, for example, when you go to the USA, you may use a credit card to buy US dollar, or use a credit card to buy things in the United States in terms of the US dollars. Of course, there are disadvantages because you are given so high the flexibility of payment. You have to pay a very high interest rates, as high as over 40% per year. As well, you see, if you are not able to repay your credit card on time, you will be charged a lot of interest. Look at the picture, 35% per year. 35%, so high. Of course, you will damage your credit rating because overborrowing or overspending without the ability to repay on time will damage your credit rating. This may lead to future borrowing of money, borrowing of loans from the other financial institutions. Second, you may apply for many credit cards, and this will lead to credit card bills. Because you need not make payments immediately by using credit cards, and so you may have the feeling that you need not pay money immediately or in a short period of time. So you may try to apply a lot of credit cards to use the credit limit of one credit card to cover the debt of another credit card. But such kind of snowball effect will cause you bankrupt. Okay, you're going to compare different types of consumer credit. First one, personal loans, bank overdrafts, and credit cards. You should first know to tell the differences between the revolving nature or non-revolving nature of these types of consumer credit. Personal loans is just a straight line. That means it is not revolving. It is non-revolving. While overdrafts and credit cards are revolving credit. That means you are given the limit by the banks or by the financial institutions. This kind of credit available for you may change depending on how much you have spent. That means the outstanding amount. So if you have paid the outstanding amount, the credit available will increase as well, just like revolving facility. Second, a number of repayments, because revolving, just like a merry-go-round, that means there's no fixed repayment periods for bank overdrafts and credit cards. While for personal loans, once the bank grants you or make you the personal loans to you, you are required to make fixed installments to the bank or the financial institutions. Of course, about the fixed amount of repayment, this fixed repayment period imply fixed amount of installments. Okay, not fixed means no fixed amount of repayment. Of course, this will lead to another consideration of flexibility. Fixed periods, fixed installments means lower flexibility. On the contrary, no fixed repayment amount and no fixed repayment periods imply high flexibility. Remember, great benefit will cost you money. So at the end of the row, you see the interest rate for personal loans are usually lower than the interest rate which are charged by the bank overdrafts and credit cards, because banks and financial institutions have given you a lot of flexibility. Examination drill. Which of the following about credit card is not correct? A. Credit cards will pay part of the payment on the due date. That's correct, right? This is what we call minimum payment. You may pay the minimum amount of the outstanding amount to the credit card companies. But of course, the remaining balance have to be paid interest as well. But according to the rules of the credit card companies, even though you make a minimum payment, the interest charge was not the remaining balance. Not the remaining balance, but the total amount of the loans outstanding. Remember, this will cause a very big snowball effect. A, correct. B, credit cards have credit limits, correct, right? C, if a credit card holder's retail purchase exceeds its credit limit, the card issuing institution will apply a high interest rate as the punishment. That's correct, okay? Because the card company has to face a lot of risk if you still not repay on time. D, eligible card holders in Hong Kong only can have one credit card. That's not correct, okay? You may apply many credit cards. Go on. What are the advantages and disadvantages of using credit card? Okay, about NOCs. One, it is convenient and safe to use. Second, it has payment flexibility. Next, it has worldwide acceptance and circulation translation. The disadvantages are: one, high interest costs for you, damage your credit rating. It will cause credit abuse. Okay, going to the personal credit records. What is it? It is a record of the credit history of your consumer, your credit history. That means the financial institutions will base on the borrowers. That means your credit worthiness to make the decision to lend. That means he will check, just like your report card. He will check your conduct. He will check your number of lateness, your comment, and so and so. What we call credit worthiness. Okay, to see if the financial institutions will make a decision to lend to you. We have two kinds of rating, just like our school conduct. We have a conduct mark and we have a conduct grade. Okay, the first one, conduct score, just like conduct mark. Okay, measures the borrower's credit worthiness by using a numerical value. Okay, just like out of 100 mark, you score 85. That's quite good. Another one called credit rating. It represents the ability of an individual to repay the debt by using a rating, just like a grade B plus, just like on the grade. What are the factors affecting credit worthiness? First one, the applicant's financial situation. That means it depends how many assets you own and what are the liabilities now. So the financial statement, okay, of your financial statement is one of the consideration. And the second is about your occupation. If you are a civil servant, that means your income is stable and steady. While if you're a salesman, that may be a good news to the financial institution, because a salesman has a big salary this month, but may not have any salary next month. The salary will fluctuate a lot. This will cause a high risk for the financial institutions to lend to you. Just like this, civil servants have a stable income. They may enjoy a lower interest rate. Of course, your past payment record, that's your conduct grade or conduct mark. Okay, what is the personal credit record? Okay, just the next one. How does a high amount of liabilities affect one's credit worthiness? That means if you owe a lot of money to many different financial institutions, what will this affect your credit worthiness? So number 5, personal credit record is a record of credit history. Okay, credit record means a record. Credit means credit history. Okay, of a consumer. Next, more liabilities would lower one's credit worthiness. Okay, I've told you that once the question asks you affect, it means increase, decrease, or remain unchanged. That means lower. Okay, because why? It means the liability of an individual's repay the debt is lower. That means if you owe a lot to many firms, that means if I'm going to lend you money, I'll see the high risk of bad debt because you are not able to pay me. You have the priority of your money giving to me, it will be very low. Personal credit reference in Hong Kong. We have a company called TransUnion. TransUnion in Chinese Wanlun. In Hong Kong is the first and only consumer credit reference agency in Hong Kong. Why is important? Why is maintaining a good personal credit record important? First one, remember this is a credit record. It's about getting a loan. Remember, not putting your money in a deposit account to get interest income. Not this. Okay, remember to borrow money from the financial institutions. So it ensures the chance to get a loan. That means you will most probably obtain a loan from the bank because you have a good record. Second, good personal credit record means people can get a loan when they need it. Financial institutions are not willing to make loans to people who have a bad personal credit record because it's risky. It's called default risk. You may avoid being charged higher interest rate because your repayment record is good. So the bank will see a lower risk to lend to you. So the banks are willing to offer you a lower interest rate for the loan. Of course, if your credit history is very bad, very low, so the institution will charge you higher interest to cover the cost of risk. What we call compensate for the risk. Maintain a good personal resume. Remember, resume. That means the record for your for the reference of other institutions. A good personal credit record is part of maintaining a good personal resume for individuals. That means a personal resume has a lot of information about this, just like the testimonial given to you in Form 5 after you are going to leave school. So a good personal credit record is one part of the personal resume. Okay. A person with a bad personal credit record is not suitable to for handling some financial or accounting duties which are sensitive. That means if you are very bad at money, that means you spend a lot, over borrowing, overspending, without taking into account the ability to repay the debt. That means you are not suitable to do the accounting jobs or jobs related to financial duties. So you'll lose many chances in your career. Go on, use credit responsibly. And maintain a good habit. How to maintain? That means how can you keep a good record? First one, use credit responsibly. That means if the credit card company offers you a credit limit, it does not mean that we'll use it all of the credit limit. Okay, use all of the credit limit. You may use it responsibly. And of course, habit is very important. Discipline is very important. Okay, so you have to maintain a good habit of financial discipline. That means if you are not able to earn much, do not spend more than what you earn. Avoid applying for too many credit cards. Of course, right? Snowball effect. Repay on time. Okay, it does not mean that you. Applying many credit cards is not a problem, except that you can repay on time. But of course, there's a temptation that you overspend with the use of the credit cards. So try not to apply so many and repay on time, so that the credit card companies will not charge you high interest. Okay, case. Why do we need to maintain a good personal credit record? Let's think. Apart from a personal record, which other kinds of consumer credit could Mr. Yan choose? Name two of them. Here are one of the examples. Why is a bank not willing to make a loan to someone who has a bad personal credit record? According to the case about why do we need to maintain a good personal credit record? So okay, look at one by one. The first one, credit card and bank overdraft. Okay, these are two examples. Second, it's too risky for the bank to make a loan for someone who has a bad personal credit record. The key word here is risky. Okay. Third, we can ensure the chance to get a loan. These are very important consideration for you to spend a lot of time to maintain good discipline in finance. We can ensure the chance to get a loan because when you grow up, you may have a lot of chances to ask for loans from the banks and avoid, of course, being charged high interest because if you still be offered loans, you have to pay a lot of interest out of your income to the banks. That's a very bad thing to you. That's the end of chapter 2.